Hey everyone, today we're going to look at corporate balance sheets and earnings and why I think that the earnings in the next 2 quarters are most likely not going to be where many analysts are expecting, or B, they're going to have to revise their earnings in order to see the stock market go higher. And let's just look at a few things. Let's look at the corporate balance sheets. Just look at this in 1998 to 2000. Let's just zoom in, control and plus at the same time for you guys watching on YouTube so you could just see the numbers a little clearly. Look at in blue, equity value. By the way, this is off of Carl Denninger's market-ticker.org. Notice how equity peaked in around 2000, okay? And then we see in 2007, 2008, another peak. And this data actually goes to 2012 quarter 3. So if you extrapolate this a little more, it's probably a little higher. So we see that we have higher highs. So if you see right now what will probably happen, if the charts follow the same pattern, you may see a top coming off soon. And it could be as early as next quarter or the second quarter of next year. And then what's going to happen? You're going to see a slow but steadily decline based on how this business cycle is working. But this time around, what's common with 2000 and 2007, it was an equity bubble that was propped up by easy money by the Federal Reserve. And you see the same thing over here. So if you extrapolate the data, it just seems that the market could potentially go higher, and I've done videos on this, but it just seems that it may take, or we have a lot more to the downside than to the upside, in my opinion. And once again, don't invest based on what I'm saying. These are just my own thoughts and observations. Now, I want to look at something also unusual. I look for things that are out of the norm, and it just seems that when it comes to inventories, the last quarter, look at the spike, right? This is the change in private inventories, and it's provided by the U.S. Department of Commerce. You could also Google this, just type change in private inventories, :farm, and you'll find this. Look at the spike in inventories. So the thing is, this is the reason why you had high GDP of 4.1% the last quarter. It's a buildup of inventories. But here's the catch, though. This is only going to work as long as the firms liquidate their inventories and you have buyers to buy the products. If they don't have that happening, then they're going to have to sell these items at a fire sale price. And if the earnings aren't revised by Wall Street for forecasting purposes, then you're going to see all these companies miss on their earnings, and that's not going to most likely be positive for the stock market. So that's what I'm looking at here. This is unusual activity here, and I could show you what happened with retail sales this past Christmas. Now look at this. Retail sales, traffic decreased last week. This was on the 23rd of December. This is when it was printed. It says Shopper Track. They track all these trends. Let's read it. Last week, the last chance for procrastinators to finish last-minute holiday shopping, but weather prevented many from getting to the store. ShopperTrack, the world's largest counter and analyzer of retail shopper traffic, reported that for the week of December 16 to December 22nd, GAFO, in-store retail sales, decreased by 3.1% from the same week last year. Retail brick-and-mortar shopping traffic decreased by 21% compared to the same time period in 2013. Bad weather throughout the country kept some shoppers away from stores, said Bill Martin, ShopperTrack founder. This past week was their final opportunity to complete their holiday shopping before Christmas, and though many did finish making their purchases, retailers did not see as many shoppers as last year. Despite more markdowns and promotional efforts from retailers, Super Saturday saw a decrease in retail sales by 0.7% compared to 2012. And it goes on and on and on. But what I wanted to look at is shopper traffic decreased 21% compared to last year. and the excuse was bad weather, but still, it decreased 21%. All of that most likely doesn't have to deal with weather. And if you want to look at another thing, though, you do have online shopping. So if they cannot shop in store, they could definitely go online and buy items. This is not the 1980s. So that's a red flag. I mean, you could blame the weather all you want, but at the end of the day, when you have the inventory buildup to the extent that they have, and you see shopper traffic go down 21%, that's a red flag in my eyes. And then I could still be wrong, though, about my analysis, and I will show you how I could be wrong. Once again, I'm not guaranteeing anything, and I'm trying to show you the other side of the story. And this is what Jason Barak out of Wall Street for Main Street told me the other day. Okay, this is David Einhorn's, just a newsletter that he put out, or just a letter he put out, talking about where his stocks were, what picks he made, and he just talks about the market a little bit. And he talks about earnings here, and once again, this is what Jason sent me. And this is what he says. The game of earnings expectation conflation continues. It's a bit like limbo with a twist. Though the bar gets lowered every round, the goal is to make it over the bar, rather than go under it. Here's what the current round looks like. At the end of June, third quarter S&P 500 index earnings were expected to grow 6.5%. In July, as actual earnings started to come in and companies lowballed the next quarter's guidance, index earnings expectations were likewise adjusted lower. As more companies reported beat and lower earnings, market expectations continue to fall to the point where third quarter index earnings growth is now expected to be half of what was forecast in June. Of course, when earnings are announced in October and they beat the guidance set in July, everyone will celebrate with cake and ice cream. Never mind that the earnings are actually in line with the original June predictions, or that they've lowballed guidance for next quarter. If anyone noticed that, they wouldn't be able to move to the next round by lowering the December bar, which is currently set at 13%. As the S&P index has advanced this year, mostly through multiple expansion, the index is no longer cheap, particularly considering what we are now almost half a decade into an economic expansion, and earnings growth is unexciting. So what he's trying to say is that the bar gets lowered every time around, and guidances are revised or earnings are revised, and because of that, if they beat the earnings, guess what? People are going to buy the stock market. And this is where I could be wrong, where I think that we're getting closer to a top, in my opinion. And the only way that I probably will be wrong is that if companies continue to beat these lowballed earnings, right? In my opinion, I don't think a lot of these companies are going to be doing well, especially with the headwinds of Obamacare next year and a potential tapering. And then 3, we have to look at the fact that all of this easy money is going to be exhausted soon. Their marginal benefits of easing, even though I don't agree with it, the first initial benefits came out in 2009, 2010 when firms were deleveraging. Okay, that's when, number one, you would see the greatest stock expansion during that time frame, and then you saw the same thing with QE2 at that time frame. But put that aside now. So if you look at the fact that Einhorn is talking about how these companies have to lower the bar, what is the market going to figure out in the next few years at most? Well, they're going to probably short the daylights out of the market, in my opinion. But hey, once again, I could be wrong. Let's just look at this one Twitter chart that I showed you yesterday. I showed you this Twitter chart yesterday, and what I said was that it must have been like $67. I did this video where Twitter was at. Or is it like around that time frame? It was like close to 11 Central-ish. So this is what I said. I said that, hey, this was unusual activity with the volume here on the 26th, and it just seemed that it had run up so much based on volume purchase. And then what happened in the morning time? Well, there was a downgrade of Twitter right after this volume spike, and analysts said that, you know what, this is getting a bit too ahead of itself. I think it's an analyst firm called something with the M. I forget what it's called or how to pronounce that. But anyways, the downgrade came, and I was saying like around this time that, you know what, this is unusual activity going on, especially with the price. And then whoa, before the end of the day it went down like, I don't know, $4 after I did that video, which is kind of interesting. And my point is that with easy money, and when you have easy money, you're going to see a lot of people trying to find yield, or they're going to try to find stocks where people are shorting like crazy and try to take advantage of it. And then you're going to get all this buying pressure, right? Whether people are trying to cover shorts, or not cover shorts, but whether people are trying to make some speculative position or try to trade in and out, high momentum trading, HFT, whatever the case is, some people obviously are going to get burned. And this is the problem of easy money, right? You see a stock with no earnings coming at $42 a share, going all the way to roughly $74, $75. I mean, this is a disaster waiting to happen, in my opinion, some of these social media stocks. And what happens if you see them miss earnings? Or what happens, they don't have earnings, some of these stocks like Twitter, but what happens if you start to see more of these downgrades, right? I mean, I'm sure some of these analysts are thinking like, okay, some of these valuations make no freaking sense. And what happens if you see these volume spikes? Initially, it could send the stock price higher, but eventually, it's, in my opinion, because of the leverage, you're just going to see these stock prices just go down, not in a heartbeat, but you're going to see these volatile moves like $10 to the downside in that day, which is ridiculous for a stock which is like $74. So that's something to note. And you have to remember that a lot of these companies, you have purchasing of their own stock. And long story short, you take the numerator, which is earnings, divided by the amount of shares. And if you take away some of those shares outstanding through the repurchasing of these shares, guess what? If you miss on the earnings, the stock's going to most likely go down. And then come the downgrades from Wall Street. Then come the downgrades. You could see a bunch of price actions like we've seen with Twitter. Once again, this is the short term though, right? Who knows? You may see people pile right back into Twitter. I'm just saying that right now, it just seems that we're probably at 2007, 2008. It doesn't necessarily have to be a Lehman moment, in my opinion. What I see happening though, most likely a stagflationary environment. So it's going to be most likely a trading environment, in my opinion. I mean, initially I thought this would be a Lehman moment. I did do an interview with Manarino, I think in like August or September. I thought this was Lehman based on what was happening in the Chinese repo rates. You actually saw a spike up in the Chinese repo rates this month, but I think that central bankers are going to react differently than they did during 2007, 2008 when you had the LIBOR OIS spreads pop up. And I did do videos on this as well, discussing this. But anyways, guys, thanks for listening to me. I'll do another podcast probably soon, and I'll talk to you another day, guys. Thanks a lot. Bye.